Is it possible that something as simple as hot dog water can help you beat the stock market? Stay tuned to find out more.
Major fraud scheme has just been uncovered.
Financial fraud cases surge,
raising concerns about the broader
Who's
economy.
really behind the biggest financial
Digital
fraud?
fraud at an
a
all-time.
major fraud case with
Digital
millions of
fraud
dollars.
cases are rising faster than ever before.
My name is Rob Bezdjian, and for the past 5 years, I've spent over 7,000 hours proving to regulators, and now to you, that Wall Street has been defrauding investors through the creation and distribution of complex, structured products. How will I prove it? Simple. I'll show you how I profit by betting against these products. Welcome to modern day card counting. In this episode, I'm unveiling the structured fraud dashboard and the man in the mirror model, a strategy that flips this fraud to your advantage. Doubling the market's return with just a quarter of the risk should be impossible, but it's not. Let's go. Over my last 2 videos, I've provided an update from the first 5 years as an SEC whistleblower regarding various structured financial product fraud, including results of trading over 60 leveraged exchange-traded products over 24 months while crushing the stock market with a 53% return while the S&P 500 did 15%. And I did it with a quarter of the risk of the market. Grok says it's impossible, and it should be, but it's not. In this video, I'm going to show you one of those models I used to do it and prove my claim that this is fraud. Wall Street used grade school math to defraud investors of well over $100 billion, with over $15 billion being added each year to that fraud. How do I know? Because I'm simply mimicking the fraud, and you can too. But first, I need to show you that this is even possible, and that lesson can only be found at the bottom of a glass of hot dog water. Back in the year 2000, the record for Nathan's hot dog eating contest stood at 25 1/8 hot dogs. In 2001, a competitor named Takiro Kobayashi doubled that record by eating 50 hot dogs. How? He read the rule book, thought outside the box, and changed his approach. Instead of eating hot dogs the way everyone else had for decades, he separated the buns from the dogs and dipped the buns in the water to make them easier to eat. It was so obvious in hindsight, yet no one had thought to do it before. Fast forward to today, and everyone follows Kobayashi's method. The record now stands at over 76 hot dogs, set by not him, but by another named Joey Chestnut. The same concept applies to financial markets. A simple shift in paradigm can completely change the game. Remember, no one would have thought a Ponzi scheme was possible prior to Charles Ponzi. I've simply found and have proven mathematically a fraud that you have never heard of or can conceptualize yet, but you will. A reminder, I'm claiming that Wall Street created leveraged exchange-traded products to profit from the embedded decay they created through basic mathematic principles. Simply put, if they sell investors $1 billion of digital snake oil and hide it in your pension fund, endowment, sovereign wealth fund, or convince their Wall Street friends to embed it in the assets you're paying them to manage, they've hit the jackpot. Let me give you a hyperbolic example that demonstrates the point. Let's imagine we are Wall Street and we want to give clients the ability to bet on a daily coin flip. So we create a tails financial product and tell clients that every day we will flip a coin, and if it's tails, the client will make a 50% return, but if heads, they will lose 50%. We then issue $1 billion through our network of trusted advisors into pension, endowment, sovereign wealth, and hedge funds in small enough quantities that any one fund's performance will be affected, but not enough for anyone to notice or to take action on. Now let's see what the first several days bring. Day 1, coin flip lands tails. Investors see their $1 billion grow to $1.5 billion. They love us. We're doing God's work. Day 2, we flip the coin. Another tails. Investors' holdings have now grown to $2.25 billion, a 125% gain in 2 days. But who takes that $1.25 billion of exposure? We do. Wall Street. Day 3, it's heads. The investment loses 50%, dropping to $1.125 billion. We have recouped $1.125 billion in paper losses. Day 4, heads again. The investment drops to a total value of $562.5 million. We, as Wall Street, have now made $437.5 million, and the cycle continues. This is not a hypothetical scenario. This is exactly how these products are structured. Though the losses aren't as dramatic as 50% per day, but they do add up over time, and some average 5% or more per week. Here's a long-term chart of UVXY, SOXX, and BOIL. Notice anything strange? To make things even worse, Wall Street manipulates these products further by instituting reverse splits when their price drops too low. Then they reissue the shares at an artificially inflated price. This requires that the starting price is adjusted, which is why UVXY shows on a chart as being worth over $30 billion at the time of its issuance. Now, I'm likely the only person in the world that cares that random strangers are being robbed enough to do anything about it. Certainly to invest 5 years of my life and choosing not to immediately profit from what I can do. My story and the work to get here is one I look forward to sharing. But first, let me present the man-in-the-mirror model, which over the long term substantially beats the S&P 500 with roughly a quarter of the risk or volatility.
I'm happy to present to you the man-in-the-mirror model. First, I want to talk about the characteristics that we're exploiting. The first characteristic that is a verifiable fact is that the long leveraged products, an example would be TQQQ, is mathematically different than its paired product, the inverse leveraged leg SQQQ. It would be like Wall Street creating a pair of products that should have the probabilities of a coin flip, 50-50, and then weighting the coin so head shows up much more often. We are using that fact and the mathematics behind it to take advantage for our benefit. In the example I gave previously, we talk about the product decay. We also are going to exploit the fact that these are issued more often than not in pairs. This means that these products for the issuers, because they have exposure and their Wall Street counterparties, these are self-hedging. If TQQQ and SQQQ are supposed to be inversely correlated on a daily basis, it means that throughout that day, they are self-hedging. And as we represented, over time, they will both decline. We are going to reset the man-in-the-mirror model on a quarterly basis. I want to liken this to card counting, which I hope you're getting from my previous explanations. We are effectively taking advantage of mathematical probabilities just like a card counter would at a blackjack table. We are trying to make a hand, so to speak, that we can win. Our goal is to play many hands, and our goal is to win more hands than we lose, and on average, make more money from the hands we win than from the hands we lose. We are going to reset the man-in-the-mirror model every quarter. And I jokingly say in the book that Wall Street loves quarterly bonuses, so that's the same time frame in which we're going to reset. As we add to the positions in the man-in-the-mirror model, we add to the shorts. This would be the equivalent of asking for another card at a blackjack table. Once we complete the model for the given quarter, is like the hand being over. At the end of that hand, we are going to have a gain or we are going to have a loss. When we pair this with all the products from a given issuer, it is the equivalent of playing every seat at a blackjack table or maybe multiple blackjack tables. Over the long run, we will outperform the market substantially, and because of the diversification, we will do so with much less volatility or risk compared to the market. That is my claim. All of it is mathematics, so 100% of it can be validated. The man-in-the-mirror model is much more simple than counting cards. We're going to short X value of the long leg and 1.25X value of the short leg. In the example I give in the book, and what I will show the public is I'm going to set those values at the X value at $800. So in the long leg, at the start of each quarter, we're going to short $800 worth of whatever product we're trading. I'll give the example of TQQQ. On the short leg, the inverse leg, SQQQ, we're going to short 1.25X, which under this scenario, this example would be $1,000. Then, as one side or both sides decay in value, when they reach a 10% decay threshold or decline, we are going to add to the short back up to the original starting value that we did with the quarter. So on the long leg at $800, once the product's value drops below 720, the value of the short, we're going to short additional shares until we get back to the $800 limit. On the inverse side, we're going to start with $1,000. Once it drops below $900, we're going to short additional shares until we reach that $1,000 limit again. We're going to repeat those simple rules from the start of the quarter to the end of the quarter. At the end of the quarter, we will have a gain or a loss. Once again, we're aggregating that across all of the products of a given issuer. We're going to repeat that process 4 quarters a year, every year. Now, I encourage you to validate those simple rules on your own. Do it through a spreadsheet. You can follow my portfolio, which I will be making public, or we've created a dashboard that you can use to follow along visually.
Let's remember that Kobayashi beat the record number of hot dogs eaten by double. I'm claiming no different. In hindsight, I'm pointing out the obvious. I was just the first one to look. Listen carefully. Any financial product whose performance gives you a multiple of the market's daily return and resets each and every day is solely based on mathematical probabilities. And these probabilities can 100% be exploited, just like counting cards. With my models, you may not win every hand, but you are mathematically guaranteed to win more hands than you lose and to win larger hands on average. Now, my team and I have built a dashboard for each leverage product to backtest the performance of the man in the mirror and other models I presented in my book, Structured Fraud. One of the models even returns roughly 5 times the market's return since the inception of these products, with a beta or risk of 0.5, which is half the risk of the S&P 500. A sample of that dashboard for all Bank of Montreal products is provided free of charge at Fraud Research. I want to make this point clear. Unless Wall Street colludes with regulators to change the rules, like the rules in blackjack were changed 50 years ago to prevent card counting, these models will work in the future. For that reason, and to protect investors, next week I will be trading these products for the public's validation and scrutiny. My starting portfolio will be presented live and for free. Sign up at fraudresearch.com. I will also be doing live demonstrations and more, and my performance and daily trades will be provided to any journalist that wants to see. As I stated back in 2021, allowing the world to watch in real time will protect investors and collapse this fraud. In the next episode, I'm going to validate my claim that pension fund managers are holding these toxic products at the expense of your retirement. I will show how just one fund lost millions as the manager of a Fortune 500 company held roughly $100 million in product SQQQ alone, which was the highlight of my last video. This likely violated fiduciary responsibility. It definitely violated the warnings in the prospectus and rules and regulations from the SEC. And that's just one pension fund manager. How many others are holding $100 million or more? Remember, SQQQ has made Wall Street roughly $15 billion. A lot of $100 million holdings had to be taken over that time period. We'll find out more next time. Cheers.
I'm